Good afternoon, everybody. How's it hanging? I'm an associated member of T3 Trading Group, which is an SEC registered broker dealer and a member of FINRA. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Here is my position disclosure. It's the same. All right. Um, 3 down days in a row. SPY's down 0.5% here again. SPY's 0.5% down. We closed about where we opened. Qs are down 0.5%. The IWM is down 0.9%, so relative weakness again from the Russell. They were relatively weak pre-market. During the day, these indexes moved pretty closely with one another. Um, so not as much of the Qs moving in one direction and the IWM moving in another direction as we have seen a lot of recently. So IWM opened up down on the most on a percentage basis and closed down the most on a percentage basis. TLT here exactly flat. The dollar up. The dollar up. Let's go back to that chart in a second of the dollar. Gold up 0.5%. Bitcoin smoked 3.8%. I do think that this is becoming very notable. Ethereum down 6.5%. Solana off 8% on the day. So again, I do think that's becoming notable. Oil was up again today as well. So over to the chart. First, just the dollar daily chart, ZUPTF representing the dollar. Starting to break out. Starting to break out here. We had been like eyeing this like 2750, 2760 on the UUP for most of August. You had a fake breakdown of the range, a false breakdown of the range in mid-September here around the Fed. And now that false breakdown is actually starting to lead to a break up. And I haven't seen any updated positioning information on the dollar in a while. Last I saw, people are heavily short the dollar. So you could get a dollar squeeze, and that is a negative for U.S. equities. The dollar moving up is a negative for U.S. equities. So, is SMCI getting hit here after hours for some reason? Sorry, I just got filled on the bid in SMCI. So yeah, so let's keep a close eye on that. Now let's take a look at the indexes here and see what the updates look like. So again, 3 down days in a row. It's another negative day. We finished down 0.5%. We're still not getting any of the real acceleration, I think, that leads to more of a downside positioning squeeze based on everything that I've seen. And I guess the three main things that I'm looking for that could create acceleration are one is the systematic volatility control universe, which moves a lot of money. Two is the CTA trend following community, which is also systematic in nature. And three is this like leveraged ETF rebalance phenomenon that creates a degree of what Charlie McElligott describes as synthetic negative gamma to the market. And the data that I've seen would all say that none of that has really triggered it, or if it has, it has not been very dramatic, at least not yet. So that becomes the main question to me is can we trigger forced selling in the market? If we do, you could get a much faster move down. Sometimes these down moves they start as grinds. Right now we have a grind lower, and then they can accelerate, and the acceleration comes most likely from the market structure events that I'm discussing here. So, we did see that if you could go down 0.5% in the S&P, that you'd get a little bit of selling coming in from the vol control universe. But then I think if you be down 1%, it increases exponentially. Like I don't remember, I'm not sure what 0.5% was. Probably like a billion or two to sell, very small. but like a full percentage becomes 8 billion to sell, and then 2% was like 47 billion to sell, or some really wild number. But again, these down moves that we've had, 3 down days in a row, it's been like 0.5%, 0.3%, 0.5%. So total, I think we're about like 1.5%, maybe slightly less than that, from highs. So not really enough to trigger the vol control selling to come in, not really enough to trigger the ETF rebalancing to the downside in a large way. The Nomura note said if you can go down 3% in the indexes, that you would get like $90 billion worth of selling on the ETF leverage rebalance. So we're working our way towards that, but we still haven't actually got to that point. And then the final one again is that CTA sell trigger, which is probably sitting somewhere around SPX 6500. We have not had a perfect update on that, which is also the area actually that I would expect the market to really attempt to support, kind of right in front of that 6500. So we'll see if that's able to trigger or not as well. Um, so that is kind of from like, can we get acceleration? When it comes to today's trading session, we had a day three gap down, which was notable. And the first major area of support that we were looking at for today was about SPY 655. And in the beginning of the day, and I think that this is because we gapped to below yesterday's low, in the beginning of the day, we accelerated lower. So we became extended on the 5 minute chart because of the gap, and that extension got even more extended because there was momentum selling in the beginning of the day, some degree of downside escalation. And that ended exactly where it should end, 655. Almost to the dot here with the SPY. 655.08 is the low of the opening move. Um, it corresponds with where the 21 EMA is in the daily, and it corresponds roughly with the area that is the low of the Fed day, which is really 654 spot 30. So I'm very, very closely watching this like 654 to like 655.50 support zone to see if that can break. But it makes a lot of sense that on a day three gap down, when you had extension into that level, that they were able to hold that level on that first test. And that's what happened. And by the way, we called out longs there. Really good call out for me personally. I was buying the IWM. I think a few of you guys were buying individual stocks off that level. You could have bought the Qs. I think a couple of people bought the Qs. That was a great bounce back trade for the long. For me, for my IWM trade, it was more like a scalp. I did it with the TNA, but I was out of it relatively quickly. Made my money, got out of the way, and it was a decent trade. And when we bounced back, I felt that we bounced back like what I would describe as too much. Um, if you really want that like downtrend day or that downward momentum style of day that continues throughout the day, we all know what that looks like. We especially know what that looks like on the upside when you get the grind higher trend on the moving averages all day on the 5 minute chart. If you want that on the downside, which can happen, I thought we bounced back too much. Ideally, you wouldn't have even really breached the 80 EMA on the 5 minute, and you'd be getting new lows. Less ideally, but not the end of the world, is a little bit of a deeper upside pivot, but you're not breaking highs. Once we broke highs, once we got above the 21 EMA on the 5 minute, I was like, the probability of getting like real downside continuation is much lower now. However, the one thing I did know was that we had two like midday sell-offs 2 days in a row. Yesterday we had a sell-off that started at like 11:30, 11:45. That was a big, we gapped up, we sold down, we consolidated, and then we accelerated lower at like 11:45. Two trading sessions ago, we actually accelerated lower at like 1:30. So I did want to leave open the possibility that the sideways price action that we were then experiencing, which I felt was too big of a bounce for that beautiful like downtrend grind that you would want to see if you're short and want to continue to push the short side. We bounced too far, but I wanted to leave open the possibility that we could get like an afternoon rollover, and we actually did. We had a decent afternoon rollover that ended at 2 o'clock. By the way, 2 o'clock is when the early MOCs come out for people who are able to see that. Um, and then we bounced back. This is when I took off for a little while. I went down to the Chicago Board of Trade. I got to hang out a little bit on the SIBO S&P options pit for a bit, which was pretty cool experience. And then while I was gone, the market had a pretty big snapback rally from that extension. But we held support twice today. That big daily chart support area that I just mentioned, like 654.30 through like 655.20 is what I would describe it. It held twice today. And again, it makes sense that it was able to hold there because it was a day three to the downside. And into a first test of support. And now the question becomes, now that we've held support here, what happens next? Was this just like, all right, day three down on a first test of support in a market where everybody's become so used to and so comfortable buying the dip that of course there's going to be some supportive buying there? And then, the more times they're able to test that level again tomorrow or early next week, you could break it and you could lose it. Or is that it? Is that the dip of September 2025? The market technically here is not broken by any means. I know that Dennis was trying to describe the market as now maybe more neutral. I'm not even sure that I agree with that. I actually think if you're just purely judging the technicals of this market, they're still very bullish. Maybe you could make an argument that the trend has become challenged. That's the term that we used to use when you would get equal lows or equal highs within an uptrend as opposed to higher highs and higher lows, right? Like an equal low does not break the uptrend, but we would describe it traditionally as a challenged trend because why are you getting an equal low? It should be a higher low. So it is notable that we are getting the equal low, that we're getting a test of support. I mentioned it in yesterday's afternoon meeting, and I still think so. The feel of this market has changed a little bit. Like we had 3 down days in a row without any real new news. Previously, the only way we've been able to have like a single down day or the couple instances of 2 down days in a row since the April low has been because there's been an event that has occurred, a really bad employment number, something like that. And then even those dips were very, very quickly bought. This is the first time where the feel of this market is different. We're selling down just for the sake of selling, as opposed to needing an event to push us down that creates, the blip lower that is immediately bought. So for the moment, it just feels like a technical pullback to that equilibrium zone. But I would argue that the feel feels different. And, anecdotally, for what it's worth, everywhere I look and everyone I speak to and every research report that I read is all saying pretty much the exact same thing. Oh, it's a shallow dip that's coming in here, and that's a dip that, people should buy. And I honestly am scratching the back of my head, and I'm like, with every single person in the universe saying that, is there a chance that it actually people have gotten a little bit too complacent just with how this market is, and you could get a bigger rollover? I don't know the answer to that question. The market will tell us in due time, but uh, let's pay attention to the technicals, right? Do we get like a little bit of a bounce back to a lower high that then breaks the 655 low? Do we get like a day of sideways price action and then we break the 65 low, 655 low? Or that's like technically how I would want to see the setup break for 655. Or we also do have the PCE tomorrow. The PCE is not as market moving as the CPI is, but the PCE could, if it were to be really hot, get us to break through that 65 support and actually create a little bit more of a downside momentum situation. So, for the moment, we're in wait and see mode, but we're right on the cusp of this really important support level at 655, and then again, 6,500 S&P would be like I think a very, very big level of support. If you lose that 6,500, then all of a sudden I think that you are really probably looking at a market that is accelerating. And there are plenty of other examples out there of a market that starts by dribbling lower and then accelerates lower. And if you circle back to the Scott Rubner statement that I keep quoting because I think it's so great, if you can go down a little, you could go down a lot. I would argue that we're still not even at the down a little point that triggers the selling of a lot. And that's what we're waiting to see. Can we go down a little to be able to go down a lot? Because at the end of the day, all this is basically, I think someone just said in the VTF, all this is um, three half a percentage point downside days in a market that has just gone from SPY 480 to SPY 665 without taking a break. So that's what we're waiting to see at the index level. I think we've done a fantastic job preparing for this, trading on the way down, having the right names, and then recognizing the buy today into that 655 on that first test was a really good buy for a day trade. And that we went over that specifically in the morning meeting today as well. Like 655 is the important support level. If we're extended there, that's the area where you want to take like a day trading staff to the long side. I would argue though that the market hasn't pulled back big enough for like a bigger picture buy at this point, and I would caution people to buy this particular dip too early. The SPY wouldn't hit extreme downside extension by the way that I judge it unless it got to 650 today. And now that we're actually below the 80 EMA on the daily, that 80 EMA might start moving down a little bit, which means that you need an even lower price to hit more extreme extension. But for sure, if we got down into like 650 today, that would have been a spot to take a bigger buy because that would be a huge support level and you'd have extreme extension into it. So that's pretty much where we're at on the index level. I was a little bit all over the place today, and I apologize for that. I had a late night, and then I had a few things going on today, and I was off the desk for a while, so I think I was a little bit quieter than I normally am. But I'll be back in New York next week and back to normal next week. So apologies for not having as many call outs and as much communication as I typically do. But I still think we had some solid setups that were out there, and for me, I'm very focused on just continuing to manage my open positions. I've got a lot of open risk out right now, so continuing to manage that into the down move. So it's pretty much what you got. I'm happy to take a look at anything you guys have, any questions you guys have, all that fun stuff. Yeah, the VIX is the big thing. Just kind of seeing some comments. The VIX is the big thing we really need to watch here. See if we can get VIX acceleration. You could get the market to move lower without the VIX accelerating, right? But it'd be a grind lower. And I think that that's more of what we've seen recently. Like the VIX isn't really going, but the market's making it with the VIX divergence. But now it's like, all right, we are going lower after getting the VIX divergence, but the VIX isn't accelerating even when we're making new lows. That's not necessarily the end of the world, because you can have more like of a grind down, a stair step down without the VIX really accelerating. But if you want those like, you know, 1.5%, 2.5% down days, if you want one of those get thrown in there, then that probably has to be coupled with a larger VIX spike. So we'll see how that plays out. From TG, let the market bounce here, then get more downside to break below D21 next week. I'm not sure what D21 is. The daily 21. Sure. Yeah, that's coming to a support zone. It's in conjunction with the support zone that I'm looking at. Just in time to buy the lows after Yom Kippur. Yeah, and that would potentially create a much bigger, nicer dip. That's kind of more where my head's at also. Somewhere around Yom Kippur, or maybe somewhere closer to the end of October. Um, that zone seasonality starts to turn very bullish in the beginning of November. November is a huge period of time for the buybacks. It's very hard to be short in the month of November, but now is the time if you are going to be short to be pushing it. So yeah, pretty much agree. Looks like we had Costco report. How's Costco doing? Down. Costco trading down a little bit. Okay. John M saying seasonality with a question mark. Seasonality. The first thing we want to know when it comes to seasonality as a concept that took me a long time in my career to really learn and understand is that the reason why, like, we want to understand the reason why seasonality exists, right? And seasonality exists because certain times of the year tend to have higher particular flows or lack thereof. So when you're in the end of September like we are now, as just an example, the corporate buyback bid is pretty much gone. So in that regards, I think some aspects of late September seasonality is less about selling that comes into the market and more about actually a lack of buying that comes into the market. And therefore, if selling were to come, you have a lack of buying. So, again, that kind of seems to be where we're at right now. You don't have the corporate buyback bid. Retail usually takes their foot off the gas pedal a little bit in the month of September, so you don't have that in the same way. Once we got through OPEX, we lost at least some of the gamma bid, though we do know it was very high prior to OPEX, and it's actually still relatively high for post OPEX, which is also still supporting the market a little bit. Um, from Edward, is the down cumulative or daily? I think you were talking about the ETF rebalancing. I think it is cumulative. I'm pretty sure it's cumulative. I did not see Jem. I was trying to keep an eye out to see if he was around, but did not see him. But it was pretty cool. I tried to upload a picture and throw it on the VTF. I've never had a problem doing that before. It might just be this Jalo computer because it wouldn't let me. It didn't like the type of file or something. But oh well. Yeah, Roxanne these days are barely down, like all things considered. And for yeah, we're down having these down 0.5% days, and we're like, oh, the sky's falling, right? Like so not used to the market down ticking whatsoever. That a 0.5% down day is like, oh man, you see the market crash today? I get it. I get it. Uh, yeah. For Mike Reed, if are in by the dip mode, is there anybody left to buy? I mean, there are. If you look at some of the Goldman notes that have been in Pat's note, um, there are some people who are available to still buy this market. One is retail, right? Because retail, as long as they have jobs, they make more money and they can invest it in the market. And two is the institutions. The institutions still have like very high gross exposure to the market, which means that they do have a lot of longs, but they also have a lot of shorts. So they can be short covering either because they're getting squeezed, which seems to, we've seen a lot of that in the OKLOs of the world, or because they are on the bid on the way down, which creates a cushioning effect on the way down. And they also have the capacity to add more exposure. And that there's a couple other cohorts that could come in and buy. You haven't seen, per the Goldman note, foreign investment in U.S. equities is still very low. So they're arguing that that's something that could come back in and stronger, and that could act as a bid to the market. I would argue that we might have seen a little bit of a structural change with foreigners wanting to be involved with U.S. equities. So that number might stay depressed. But there are, that I could be wrong, and there are some potential buyers that are still out there, but we know it's really not the systematic community at this point. Oh, and the corporations. The corporations never stop buying stock, right? They just go into blackout windows where they can't buy it for a little while, but they'll be right back on the bid come November, late October, November. The corporate buyback bid is what, $1.2 trillion this year? And I saw that equity issuance this year, I think it was in Pat's note this morning. I might even be able to find it. Equity issuance this year is like paltry. It's more than last year, actually. Um, but I think it was like, is it in here? I don't want to misquote the number. I definitely read it somewhere. Uh, I love looking at these types of statistics because, one of the things that we talk about is, oh, here it is. We currently stand at 147.3 billion U.S. registered equity issuance year to date versus 133.1 billion this time last year. So a little bit more than last year. And then it gets into some of the specifics on how much of that is IPOs. A lot of it's probably secondary offerings. But what you want to remember about the US stock market or any market is that it's a function of supply and demand. And when you get an IPO, that adds supply to the overall stock market. When you get a corporate buyback or you get a M&A activity, that reduces the overall supply of the market. So not even including M&A activity, for this calendar year, we're getting like 1.2 trillion dollars worth of buybacks, and maybe this registered equity issuance number becomes 200 billion by the end of the year. They're actually expecting it to be a strong October for IPOs. Um, that's still a big difference there, right? We're talking about $1 trillion of stock supply disappearing from the market. And that's important for two reasons. One is if you just have the same amount of demand from the average, people, the average Joe that are out there, but there is less stock available, it forces prices higher. And that's one of two, I think, sound arguments on why um, stock multiples for the S&P as a whole belong at higher prices in the 2020s than they did in the 1980s, let's just say. Uh, the other one is because the types of companies within the S&P are different. These are not like these are not factory manufacturing companies anymore. They're software companies, and a lot of companies can those types of companies can demand higher multiples. But I think that's just really important information. Oh, and two is not only is there less stock supply that exists, but the way that that stock supply disappears is because the corporations are on their own bid buying their own stock back, right? And that just makes a really big difference. So, is there someone out there to buy? Absolutely. It's also why these windows of weakness, that as we like to describe them, are so interesting. Like right now, where you don't have the corporate buyback bid. Look at the market, right? The corporate buyback bid, I think, averages like $5.5 billion a day. Which means that if that's the average, like if you're just taking the amount of the corporate buyback bid and dividing it by, 250 trading sessions that you get in a year or whatever the exact number is, it becomes like $5.5 billion a day. But in actuality, it's either like right now in the corporate buyback blackout window, I'm just guessing, maybe it's $2 billion. But then in a month like August or a month like November where there are heavy buybacks, then maybe it's more like $8 or $9 billion a day of buying. Think about that as a flow within the confines of all the other flows that we're talking about, right? Um, right now, because we're in the blackout window, let's assume that the corporate buyback bid is only $2 billion a day. Just using a different counterflow, if the market were able to go down 1%, then vol control is going to sell $8 billion. But that nets out to 6 billion of selling. And that's just from those cohorts, those two cohorts. And you have to, analyze the other ones as well. But again, that's what makes these like windows of weakness so interesting, is because you have a much higher ability of the market to actually be able to go down in a month like, second half of September, first half of October, for that reason alone, um, compared to in August or November, where even though August tends to be little bit of a sloppy month, it's also not a month where the market tends to have bigger crashes or bigger continuous sell-offs. I guess you could have a quick crash. We had one in August 2024. Um, because you just have this demand that never goes away and never finishes. You know, like I don't. There's not many of us here on the team, and I guess this includes myself. I was a sales trader in 2008. I wasn't trading for my own book, so I didn't start doing that until 2010. But unless you your career started prior to 2010, You've never experienced like a genuine bear market, I don't think. Sure, we had 2022. 2022 was not very deep in terms of the depth of the bear market, but it was fairly long in duration. There's been a couple other instances of that. 2015 was like a little bit similar, I think, to 2022 in terms of just a lot of weakness and sideways, but never really a crash. But what I mean is like that recession bear market where what you see is when you think about all these flows, what are we talking about? How do you lose the retail bid? You lose the retail bid because unemployment goes up, right? Um, and at a certain point, when unemployment goes up and the economy gets really bad and you're into like a legitimate recession, that's when all of a sudden companies might actually pull back on doing corporate buybacks. Right now, perversely in 2025, companies are doing even more corporate buybacks because the companies are still doing well, but there's so much uncertainty that they don't want to invest in employment, invest in R&D in the same way. Obviously, with the exception of some of the massive capex that's coming specifically from the AI companies and the Mag 7 companies, but outside of that, the more typical company that's out there, that they are like, all right, well, I'm a little uncertain right now about what's going to happen with tariffs and everything, so why don't I just buy back my own stock? In more like a real recessionary bear market, they're not going to do that in the same way because they feel like they need to actually shore up their capital reserves. And at the same time, that's when you are not having a retail bid because retail is fighting for their life to have a job. So you see, unemployment tick up to 10%, let's just say, which I don't think has happened since the financial crisis, maybe like a brief blip with COVID. Then that becomes an environment that the majority of us, myself included, not all of us, have never really actually traded through. And that's why it's so important right now, I think, to pay attention to the employment number. I think that's like the most important number for this economy and for the stock market right now, because that retail bit has just been it's been pretty wild. So hope that helps, Mike. I probably gave you more than you were looking for. From Eddie, off the open, I noticed that banks are generally strong, and specifically Bank of America. My first instinct was to short it, as it turned out to be a mistake, given that it was holding up while the market was selling off. I covered my short and analyzed that the overall sector was getting stronger, but I didn't trust the market to put the long in at the time. Okay. What could I have done better there? Or did I do the right thing in staying off, given that the market had not flipped yet? Yeah, I think that you did the right thing there. You wanted to short the banks, you wanted to short Bank of America. If I remember correctly, you brought that up in the morning meeting. So you wanted to short it, and it was too strong. So whatever, you got yourself stopped out and you moved on with your life, but you didn't want to go back to trying to buy it, or you didn't want to buy it because you're worried about market weakness. You didn't want to short it because it was too relatively strong. So you decided to just take a step back from the name entirely. And I think that that is very prudent of you, to be honest. I think that's a really good job. Um, if you could have found the spot where the market was putting in its bottom that we were communicating, and you wanted to buy something with us and you recognize the strength in the banks, then maybe you could have bought them. But it's very hard, I've always found, to be that mentally nimble when you have done the research where you want to be shorting something, and then you're good enough to be able to say, okay, I wanted to short this, but the market's telling me that's not the thing to do. So you don't short it. That's great. You're saving yourself money. I've always found it's been very difficult to be so nimble that you actually, after doing the research to want to short, end up going long something. Um, Not a lot of people can actually do that. I think it's a huge victory just to recognize, hey, I shouldn't be pressing the short here because the idea is wrong for the following reasons. So, no, I'd say it was a really good idea. From Greg, well, I agree that at the index level, markets could easily pull back in a bull market, as per Josh's comments above. I missed Josh's comments. When looking at a lot of the leaders, and four of the Mag 7s below the 50 daily moving average, the charts below the surface don't look very bullish. I certainly agree with the thought process there as well, Greg. Um, the the question goes back to correlations, right? There was another chart. I'm not sure if it was in Pat's note this morning that showed. I think it went back to 2010 that showed that correlations right now, and there was a point in 2024 that I remember vividly. The first time I'd ever seen anything so extreme. Right now, and that point in 2024 are the 2 points. They're very similar. That are the lowest correlation ever going back to the financial crisis, going back as long as that research was able to go back. And that's what creates. I remember first seeing it in 2024, which is the other period when the chart was mentioning it, where you start to see this phenomenon of Q's upticking while IWM downticks, and then IWM upticking while QQQ downticks. I had never seen that before until that 2024 massive dispersion, super low correlation environment, and that is the same degree per that chart that we got back to pretty much right in this environment where we were seeing that, in the last couple of weeks. And today it seemed like the correlations maybe picked up a little bit, but like my entire career, I'm sort of trained for like either the market is moving down or the market is moving up. And that means that all the indexes are moving down and all the indexes are moving up. But then you train yourself to look for what is relatively strong and what is relatively weak so that you can get the most bang for your buck. And then in this environment, it's like I find it very tricky because sometimes you're like, all right, the IWM is relatively weak, so if I want to short, that's going to be what I want to short. And then all of a sudden, instead of everything selling, the Qs got too extreme to the upside or something. They start to pull back, and the IWM, which is shorting because it's relatively weak, all of a sudden is bouncing because the Qs are pulling back. Um, so I think it circles back to the same questions. Can correlation increase? If the answer to that is yes, then I very much agree with your assessment here of wow, these Mag 7 stocks are not looking good. These charts below the surface are not looking good, and that could really, lead to a deeper pullback for the market. I think that is true if correlations increase. If they don't, then it's just this constant, continuous. All right, well, the leaders aren't looking good right now, but that means that the RSP is green every day, and you get the rotation. And for that to happen, I think we need a little bit of a VIX movement, but we also do know, generally speaking, correlations increase on the way down in a market. So it circles back to the entire, I think, assessment of the market that we already did of can we trigger any of the triggers? And if so, and that creates some, it becomes a little bit more violent than these tame 0.5% down days that we're having, you probably are seeing correlation increase with that and seeing a little bit of a VIX spike with that. Or we just, if you have the rotation idea though, you could still get the indexes to grind lower because they're market cap weighted, but you don't see the VIX spike. You see the SPYs and Qs grind lower. You see the IWM, the RSPV relatively strong, but you see, the Mag 7 stocks get hit. And that's another possible scenario. Um, so we'll see which scenario plays out. Oracle up $5 after market. The US version of TikTok is valued at $14 billion. Okay. I don't know how they can value something that doesn't even exist yet. Um, Trump said China is on board with the TikTok deal, with Oracle expected to play a major role in the app's security. U.S. investors are taking over TikTok, and American stakeholders will oversee its operations. It's going to be interesting to see if they're able to do a good job in terms of transitioning this or not, because that's going to be the difference between whether or not it gets adopted. The U.S. government will make tax money from the TikTok deal. From Tate. Isn't this the market where if retail loses their job, they would think they can just trade for a living instead? Yeah, that's when they're in for a real rude awakening. In my opinion, a lot of I mean, we saw this in late 2020, early 2021, and we're seeing the same environment right now where these people who know nothing about trading are making a lot of money because they're just YOLOing in call options and following along with what the Robinhood or the Wall Street Bets people are doing or whatever. And then in 2022, they all got destroyed. And I remember having multiple conversations with people who were reaching out to T3 in 2022 who were like, I made so much money in 2021 and then I lost all of it or almost all of it, and I didn't understand how taxes work. So not only did I lose all my money, but now I got to pay the government on 2021's income, even though it's all gone. I had multiple of those conversations. People who had no business trading options, don't even know how options contract works, who are making $250,000 trading them. So I actually think that sure they all think that they can become traders for a living instead, but then you're not in that same market environment right now, and everything I think is different than can they trade. To be a successful trader, you got to be able to trade any and every type of cycle and environment and be able to do this for 20 years and all the different cycles. I just don't I think when it comes to the retail community that wants to become professional traders after losing their jobs, that it becomes a situation where 99% of them fail. Um, and a percentage of them recognize that they don't know as much as they thought they did, and they seek out proper education or what have you, and maybe can make a real go of it. From Bruin, why do they wait for SPXP multiples at the higher end to start buying back? That's a great question. Well, first of all, they've been buying back for a long time. And that's a great additional factor on this market, is that this market is a bit expensive. I don't know, Varun. You know, Part of it is these executives are paid based on the absolute price of the stock, not necessarily on the multiple of the stock, right? So when you buy back your own stock, you lower the PE because the float decreases, right? So the earnings per share changes. So I think when you think about corporate executive incentives, they don't necessarily care about that. They care about supporting the stock price because that's what's going to put the most amount of money in their pocket. But that's just me figuring. No problem, Mike. From Liam, what do you make of the LEU chart? LEU. Oh wow, big day. Big day in that. Um, yeah, so it fully satisfied its extension at lows today, but now it's extended to close. Not so extended that it can't continue, but too extended for me to buy it. It's a big day one, and I don't buy day twos. But if you were on top of this name early and you knew the news and you're able to get a good price off of the 260 pivot low earlier in the day, you've got great stock. Keep some, swing some, and see if you can get continuation on it. But for me personally, I would not buy 315 in this or 320 tomorrow in it. I would think that I missed my pivot low and had such a big day today that it's already back to being extended. But it's probably one of the types of stocks that extension can become more extension, right? It's just a matter of the momentum coming in. But that's not really the way that I trade personally. There's people here, even in our team, who are good at doing that, who are good momentum traders, buying high to sell higher. As a rule, as a general rule, not a hard rule, I think as everyone knows here, I don't like buying those day twos after the big one, the big day one. But it looks great. Yeah, obviously it's got some news. Uh, I don't know. Google is up 80 cents after hours or something. So maybe something going on. Maybe it's related to the TikTok deal. I don't know. Over on the YouTube, let's see what's going on over there from AR. I think the 10 a.m. home sales number got leaked early today. I didn't see that. Do you have any more insight on what happened there? I don't. I didn't see that, and I don't have any insight on it. So apologies. I saw the number come out at 10, and that was it. From Apex Joy, do I think SEZL is forming a base? Uh, yeah. So the thing that we have to remember about a base is a consolidation. So one person's base could be another person's bear flag, and really what matters is which direction the consolidation breaks. This is a base if it goes sideways here and then breaks up and continues. This is a bear flag if it goes sideways and then breaks down and continues. So you want to keep in mind on both sides of that. And the thing about this chart is it kind of looks like it broke down. However, it closed well. It closed well. It didn't quite recapture the level, but it closed well. So maybe this is the type of thing where it's a little bit of a shakeout of this base and it gets right back into the zone, in which case it's okay. But otherwise, I don't like the idea of buying this thing while it's below, let's call it like 83.50. If it gets back above 83.50 and you're back in the range, then you can be looking for the base, if you will, to breaking into the upside. But for the moment, it broke the support down, and I would not be buying that type of pattern immediately after it broke the support down. Meta is in talks with Google to use Gemini to improve ad targeting. Okay, well there you go. It's helping Google. Sorry, just let me see something really quick. My Google position is one of my smaller ones. Why can't I find it? There it is. Okay. From Steven. Any thoughts on Cypher, CIFR? That one's been coming up on the radar a lot. People keep asking about it. They announced an $800 million convertible note today. Do you think that's already fully priced in here, or is there room for the stock to pull back? So again, this is something that I don't know and I haven't done research on, so I don't have like a fundamental take for you on it. I could tell you that this is one of the many, many, many crazy, insane charts of September 2025. Has barely touched its ADMA a single time the entire month, and it finally got wrecked today after going completely parabolic. So the thing went parabolic, it was moving up in a way that's unsustainable, and it got wrecked today, and you're telling me it had a convertible at the same time. I think this is a chunk that needs more time. It needs more time to build out. I don't like buying this immediately after it had its first down day and it did it on a ton of volume. Um, I'm not gonna say that it's broken where this thing should go back down to $9 either. I'm not gonna say that. But I'm also not gonna say like day one down you should be buying this thing at versus $11 for the snap back up to highs and eventual move to 20. I think we need to let this one build out a little bit, build out a wedge, consolidate, tighten up, and then we can have a better idea of if it's going to be breaking lower or breaking higher. And if it doesn't give that consolidation, then I would stay away from it. I mean, if it really pulled down, like tomorrow was getting to $10, you could look for a more simple snapback trade, and then maybe that snapback trade turns into something more. But for the moment, I would just be patient on this one. From Liam on PGY. Yeah, PGY looks kind of broken to me. This thing pulled back way further than it should have. Four down days in a row, two and a half of them being really big. It lost some major support levels. It's below the moving averages. The ADMA is crawling down, about to cross the 21. Yeah, this thing looks a little bit broken to me. There might have been like an oversold bounce trade in it today because it was like a day five down RDR for the bounce back, where you could have been buying back through 34 for a move back to 37, something like that. Might not be a bad risk reward, but for more than just a shorter term trade, it seems to me like it's kind of broken here. All right, gang. 5 o'clock in New York, 4 o'clock in Chicago, where I am. I'm gonna try some deep dish pizza tonight. Uh, I tried deep dish pizza one other time when I was in Chicago, and I thought it was trash. I consider myself to be a pizza connoisseur, but my friend Corey Fisher gave me a different place to try. So I'll try that. That's where I went last time. I went to Malnati's and I thought it was not good at all. This time I'm going to, oh man, the name's escaping me, but if you give me a quick second, I can tell you. Uh, this time I'm going to Pequod's. So I can give you my report on Pequod's. But I'm going in with a heavy bias. Look, I want to hate it. I want to hate it. So it's gonna have to be really, really good. Oh man. The Sterling event yesterday, it was good. Um, yeah, gut bomb. I'm expecting that. Sterling event yesterday was good. They're working on a few things that I don't. I'll mention it, but I don't want guys to think that necessarily T3 is going to have it ever or have it tomorrow. But they're talking about the 24/5 trading, getting that up and running. It's for Sterling trading software, and they're talking about potentially adding on futures into the Sterling platform as well. So it could have equities, options, and futures all into one trading software. And if you trade at T3, we don't have any individual trading software here that has both equities and futures on it. So they might be the first that does that. But I have no timeline on these things. And even if Sterling does it, doesn't necessarily mean that T3 onloads it. There's all types of other headaches that T3 would have to deal with if we onboarded 24-hour trading. You know, from a risk perspective, the additional manpower, people power, whatever employees that the firm would need to have, and so you have to hire someone who's willing to be up all night every night, managing and watching risk, and has to be someone that can be trusted, and just presents a whole lot of hurdles from a risk and operations perspective for T3, even if Sterling can do it, but it is something that Sterling is working on. So we'll see, but I have no timelines and anything. But yeah, it was cool. They're good people. I'm a big fan of. I've never used Sterling for the Pro. I've been on Lightspeed for 15 years. Big fan of the software. And I think Sterling Trader Pro's got a lot of similarities. Might even have more bells and whistles. I think Lightspeed's actually a little more dumbed down, but also a little bit more user friendly than Sterling. Sterling has more bells and whistles, but maybe is a little bit less user friendly. That's kind of the general feedback I get. But I am not a software expert by any means. Got you. And that's just on the app, huh? All right. Have a great night, folks. See you all tomorrow.